Right, as mentioned a little earlier, consumer goods firm Tiger Brands posted a 13% increase in full-year earnings to 1,575 cents, while revenue rose almost 6% to 20.4 billion rand. Samantha caught up with the company's CEO, Peter Matlare, and asked about how the Walmart-Massmart merger will impact Tiger Brands.
Massmart's always been important in our lives in terms of top-end grocer. What Walmart brings with that are a number of really useful and interesting modules and practices in terms of how they sort out what we all call the back end, whether it's around logistics, procurement, etc. I think that they bring an additional arrow to the Massmart quiver, or an arrow or two, and we will certainly continue to grow with them. Our brands, we think, are important to them. Their outlets are certainly important to us. We don't compete in fresh, but you know, their Cambridge stores and what they do in mess, cash, etc. is important to us. So those are areas where we see some real opportunities for growth. And we've been talking with them, as other manufacturers have, about how we continue to work together to drive great value for consumers.
Let's look at inflation coming out today at 6%. The SARB saying last night that it will reach the upper end of the target next year for a protracted period. What are your internal inflation predictions, and how's this likely to affect operating margins? Average operating margin actually improved in 2011, sitting at around 15.9%.
Yeah, look, we did see some price inflation in certain parts of our business, and it was a consequence of a couple of things. The one is, you know, there was constrained availability in both wheat and maize, and so that had some upward impact. On the other hand, we saw some deflation actually in the rice category. We think that in the short to medium term, as a consequence of global soft commodity prices beginning to run and a weakening rand, that inflation will feed its way through. Now, what we've got to obviously do is think very carefully about what we can and should pass on to the consumer and what we have to absorb ourselves, because you will also have seen that volumes for all of us remain under pressure. So that volume margin debate becomes a very carefully and judicious one that we've got to manage over the next sort of 12 to 24 months.
How much leeway do you have with margins? I mean, what is the worst case scenario that you look at when you look at operating profit margins?
Again, because we have such a broad portfolio, if we look at our grains margins by way of example, they're certainly at the upper end of where we think they will be. So we do think a 17-18% margin for our grains business is the kind of margin you would expect. We do look at richer margin mix of products, therefore driving some of that. On the other hand, you know, when you look at some of our other products in our groceries business, we've restored margins, but some of those margins will remain under some pressure because of cost push as well. So, you know, we target a 15% operating margin as Tiger. We think that's acceptable. We're sitting at 15.9. We think it might track back slightly. There is room for it to track back slightly. Lots of that isn't driven by price, but by cost efficiencies that we consistently look for, certainly on the back end, rather than the front end of our business, in order to reinvest in our businesses, in the front end of our businesses, and drive hopefully volumes and value.
Let's look at Tiger Brands in Africa, because I think this is really where the interesting developments are. One is your presence now in Nigeria through your JV, that 49% stake with UAC Foods. UACN, of course, listed on the Nigerian Stock Exchange. What benefits do you see coming from this JV, and how are you going to leverage on UAC's strength in the market there?
Look, the Nigerian market is a fascinating market. It's a tough market. You've got some really good competitors in that market. UAC Foods has some great brands in there. We, together with our partners, are reinvesting in that manufacturing platform. There's a lot of what we call fix-it work to be done over the sort of 18 to 24 month period, and at the same time beginning to take some of our South African brands and beginning to overlay them on the platform that UAC Foods has for us. tough market, but we do see the opportunity to grow distribution, deepening our distribution in there. We also have a business called Deli Foods. How do we begin to look at bolting Deli Foods onto UAC Foods? Can we find some synergies? We think there are some synergies. We needed to settle the businesses down first. And of course, we continue to look for new opportunities in Nigeria. We think that certainly over the next 5 to 10 years, it will be one of the most important growth vectors for any manufacturer on this continent.